Hi, and welcome to the Midday Market Update for June 9th, 2020. My name is Kevin Hill, here with Michael, Vincent, as
Good afternoon,
always.
everybody.
This is our twice weekly market breakdown at the noon hour Eastern Standard Time, where we talk about the freight markets, what's moving that, and also the news on FreightWaves.com, and it is interactive.
It is interactive, so get in your comments and your questions. FreightWaves LinkedIn and Facebook channels, we'll try and get them answered as best we possibly can, and get your comments heard to the guests that we have on the show. And speaking of them, who do we have today? I know we have Andrew Cox.
Of course. And we have Zach Strickland talking about the freight markets. Right. Our Director of Freight Market Intelligence, our lead economist, Anthony Smith, on after that to talk about economic numbers and the unemployment numbers that came out on Friday, the May unemployment numbers. And then at 12:30 via Skype, we have Kyle Lintner, who's Principal and Managing Director at K-Ratio, and then our own Detroit Bureau Chief, Alan Adler, talking about Nikola and SPACs and tech companies going public. And then we have some good news after that.
We got some good news after that?
We do.
I like the good news.
We also have some good news.
Are you telling me that the news before that is all bad?
No, I was about to say that's what it sounded like, didn't it?
It did a little bit.
I was about to say we have good news coming up anyway, right?
I hope so.
Maybe not our first headline from FreightWaves.com that Andrew Cox is going to do right now, but it is very important news, and it's about the auto industry in Mexico. And what do we have with that? Andrew Cox.
It's not great news, but it's also important and unsurprising. So Noy Mahoney reports that Mexican automotive production could fall by 30% in 2020, while their exports from the country could fall even more, up to 33%. This is according to Fausto Cuevas, the Director General of the Mexican Association of Automotive Industry. The country produces both consumer cars and heavy-duty trucks, and both sectors have been hammered by Mexico's shutting down of all non-essential business on March 30th. And Mexico is a major automotive producer. Almost every major U.S. brand and Japanese brand all have factories there, including Chevrolet, GM, Ford, Mazda, Nissan, Toyota, BMW, and Volkswagen. Cuevas also said that a 30% decline in production in 2020 and a 33% decline in exports would both be record drops for Mexico.
So, Andrew, begs a question for me just for clarity. This is they're looking at the annual 2020 overall, right? Not moving forward, but including what the shutdown has caused for the annual number, right?
Correct. This is an annualized number for the entire year.
Yeah, I mean, so this isn't a prediction of where there will be, say, third quarter this year versus third quarter last year. This is a prediction for the entire year is where it could be, which is, I mean, they're staggeringly bad numbers, but it's not a prediction of the third quarter.
It could be more of a rear view number than a forward looking number.
That's just the point I wanted to ask is are they saying that production is going to be way down in the fourth quarter, third quarter, and if so, what is their evidence? What are they talking about, or is this like prediction for the entire year?
Well, we're going to actually, Seth Holm and I and Kevin are going to get into automotive production and automotive demand here in a couple hours on Great Quarter, guys. So everybody tune into that. But yes, well, for the most part, production will ramp up here again. We've already seen just at the beginning of May that some of the producers have come back online. They're now trying to balance the act between getting the parts from Mexico and finishing products in the U.S. and vice versa. So yes, this has likely been the trough. Automotive demand troughed, at least in the U.S. in April. So things will get better from here, but that demand is down 30% year over year in the U.S., so you can expect similar drops for the Mexican production as well.
And I might have missed it in your analysis right there, Andrew, but those plants are now back online in Mexico. Is that correct, or are they just in the process of coming back online?
Well, so what the Mexican government did after they, we reported on it a few weeks ago, they had 3 or 4 different conflicting messages within a week. You could tell that the U.S. manufacturers were trying to work with them to get their plants back online. But the final announcement that was made was the U.S. manufacturers have to come with them with a plan to reopen, and then the Mexican government will approve or deny that plan, and then they come back and do it over again if it's denied. So I'm not sure exactly which manufacturers have been put online and which haven't been approved, but there have been some approved. I know that Ford has gotten back online in Mexico. I'm not so sure for GM and some of the Japanese brands, but again, it's some are back online and some are not.
And that's a very important aspect of especially the North America supply chain of auto manufacturers is Mexico, along with Canada. Everyone's really tied in very tightly together. Our next headline is a very interesting one, especially for Andrew and I, who did a nuclear verdicts paper in the Freight Intel group not too long ago, when we learned that Louisiana, the lawsuits in Louisiana are off the charts. Lawmakers have passed some kind of tort reform for auto accidents. What do we have on that, Andrew?
Yeah, Kevin, John Kingston wrote this one, and he talked about the sweeping vehicle tort reform that was passed last week by the Louisiana legislature. Again, Louisiana is known for having some of the highest insurance premiums in the entire country and some of the largest court damage awards. And that's really where the consensus ends on this bill. Right now, what happens next is very much in the air. Both houses of the Republican-controlled legislature passed this tort reform last week, again, during an ongoing special session. But Governor Edwards, a Democrat, has yet to sign the bill into law, nor veto the bill. And the vetoes to override a possible, the votes to override a possible veto aren't there, so they won't be able to override a veto if Edwards is to do so. And on top of that, it's really not clear when the deadline is for Governor Edwards to decline the bill. It could be as far out as the end of the month. But what is possible for the Louisiana legislature is if Governor Edwards does veto this bill, there's enough area of agreement on several provisions that lawmakers will likely come back together and bring a revised, crafted bill to the desk here in the near future.
Yeah, it's an interesting story, Andrew, and I went through there and I was trying to jot down some of the details. I'm not so. I don't know if you're that familiar with what's going on there, but you did the research on the nuclear verdict, and I guess this is aimed at trying to quell that type of thing, right, in Louisiana. In your opinion, did you go through some of the stuff that is in there, and do you think this kind of does it go far enough or not enough, or do you think there's specific points in there that will actually help with reducing the amount or number of nuclear verdicts?
Well, there seems to be overall a lot of good feeling and a lot of approval of this bill. So I do think that it does hit at some of the points that are necessary to fix some of the Louisiana problems here regarding car premiums and some of the big nuclear verdicts. But again, we're going to have to wait till Governor Edwards vetoes this bill or not and see if the crafted legislation can come back to hit those same points again. It's all up into the governor's hands at this point.
I think what we learned, Andrew and myself and Seth Holm, when we did the nuclear verdicts paper back in December, was that Louisiana was one of the most litigious states, or if you're a trucking company, you get an accident in Louisiana, your fault, their fault, nobody's fault. It's kind of the old saying is you just write the check and go on because you're going to lose no matter what.
Yeah.
So there's a number of states that you see a lot of nuclear verdicts in, and Louisiana might not have the huge totals that you might see in Georgia or Florida or even Texas. But if you're a trucking company in that state or traveling through that state, you have an accident in Louisiana, let's say.
Yeah.
You're probably going to lose. You're going to have to pay something, so it's better just to settle and go along with your business. And that's what we heard from a number of defense attorneys, plaintiffs' attorneys, industry experts. So it's encouraging news for the trucking industry to see some form of tort reform starting to percolate out there.
Good. Gotcha.
What's our next headline, Andrew?
Yeah, Kevin, the next one is actually a new report from the Wall Street Journal, and it is a study that they did and basically said that more people are spending more money at Amazon, but they're not happy about it. This is a survey, not done by the Wall Street Journal itself, but by RBC Capital Markets. Some of the numbers here, it says about 64% of Amazon customers make at least 2 to 3 purchases per month. That's compared to 54% in 2019, and about 45% of the respondents say they spent over $200 in the last 90 days, compared to 36% in 2019. However, the survey also reported a significant number of customers claiming they were very or extremely satisfied with Amazon. About 64% said they had such feelings in May, compared with 73% a year ago. And this isn't a one-time thing. This has been happening for the last 5 years. If you go back to 2015, that number was actually 87% said that they were extremely or very satisfied with Amazon. So this has been a steady pattern of falling. And right now, there's a big drop in the people that are satisfied, not only because some of the items that they've been needing and looking for during this time, some of the essential items like masks and hand sanitizers haven't been available to them, but also you've seen that even on basic items that typically would hit that prime delivery, that 2-day delivery, have been extended out for weeks. So people are not really happy with the service that they're getting from Amazon right now.
We all follow Amazon pretty closely here. Do you think it's all attributable to, I'll ask you both actually, is it all attributed to delivery delays, non-essential items, and over the past few months, or is this a longer-term trend with Amazon itself?
I definitely think this is a longer-term trend. I think in 2015, Shopify wasn't the type of company that it is now. It didn't have the market share that it does now. Also, Walmart and Target were just now getting into their e-commerce plays. They hadn't built out their vast e-commerce networks that they have now. So I just think people now have more options than Amazon. And you also think about click it and pick it type deals. I know, Kevin, you're a big fan of that, buying something online and picking it up at the Target or the Walmart. You can't do that with Amazon. There's no delivery center to go pick it up immediately. So I just think Amazon has less options right now than other people do, and people are taking notice on these long delivery times and not having the items that they need.
What do you think, Mike?
Yeah, so, you did ask both. I agree. I wanted to go first because Andrew's smarter than I am, and I wanted to sound a little bit smart, not just agree with everything he said. But, I agree with what Andrew's saying. It's you have more choices out there, and some others are starting to ramp up. So obviously, people are going to move to those different platforms, and maybe they have a little bit better service. So when they do shop on Amazon, they like the way it happened before, like the pick it or the click it and pick it type of option that is there. The increase in numbers, to me, when I first saw them, was like, okay, lockdown, everybody's doing this type of stuff. And I think that that's where you're buying stuff because you can't. And I do think Andrew's correct in the assumption that, it takes longer to get things that you really want that aren't essentials, right? The PPEs and stuff like that. I mean, just those type to keep your sanity and do things around the house while you're in lockdown, that type of stuff. So.
I think you're right as well. I think the click and pick it is coming. I think a lot of the brick and mortar retailers were dabbling in e-commerce. They didn't really know what to do. The coronavirus pandemic has forced them to accelerate, where it's not an option; it's a necessity to go all in on e-commerce. So you're going to see, I think you're going to see a lot of innovation going forward that will take a chunk or take at least a piece out of the Amazon empire on e-commerce.
There really is, and I was reading some stuff the other day, and it'd be interesting to get into eventually on some of our shows as it comes out more. But the difference, the ability to there's a lot of innovation and work being done around the ability to have they need more real-time inventory in those stores to do the store fulfillment for e-commerce, right? Because inventory doesn't change in the store until it's purchased, right? So 5 of an item could actually be in buggies being purchased at the time that they think it's there and trying to fulfill it from that particular store, right?
True.
So trying to figure that out is not so easy.
It's not so easy, but it's doable. And I think they are devoting more resources. If you talk about the big box retailers right now, what's our next headline out there, Andrew?
Yeah, Kevin, the next one is just a quick update on air freight capacity. Air freight volume fell more than 27.7% year over year in April, according to the latest number from the International Air Transport Association. Freight capacity fell nearly 42% year over year in April, with international belly capacity falling even more at 75%. This is a result of the mass flight cancellations due to the COVID-19 pandemic, of course.
It's kind of short and sweet, and we kind of knew this, but it really points to a lot of things. And I put this out there before, and I think it's a really interesting topic because you're seeing that the demand for the capacity didn't cause the capacity to go up or go down, right? Because the demand here we're talking about is air freight capacity, but the air freight capacity that was available was there because of the demand from passengers that went away. A different demand caused that to be available and on those flights, and so that is really the big thing to be thinking about is how does that recover from there?
That is a huge thing. I mean, those are passenger flights.
Yeah,
so
exactly.
Passenger demand has to come back up, which it has been over the last couple of weeks. So that's an encouraging metric for this economy as well.
Yeah.
It is. Thank you very much, Andrew. You can catch all those stories and much, much more on FreightWaves.com. And we welcome our next guest here in a second, Zach Strickland.
Yeah, we'll be talking to Alan about that air freight thing, I think, a little bit later. You think you didn't, or is it?
No, it won't be air freight. It'll be more auto manufacturers, OEM.
Okay.
See, that's his coverage there, auto manufacturing in Detroit. And also we'll really talk about tech companies and IPO or reverse mergers or going public through SPACs, which can be a little bit confusing. So we'll get a definition of SPACs and exactly how Nikola went public.
Oh, okay. Yeah, excellent. We talked to Trevor last week.
Huh?
We talked to Trevor last week.
We did, yeah. So you guys did on What the Truck.
Yeah, we did.
And that was what, last Friday, right?
It was Friday. Yeah,
and you can find that
Trevor.
episode on Freightcats, or tv.freightwaves.com.
Right.
It's an excellent interview that you guys had on What the Truck. And what was the big highlight? What was your takeaway from that? It was a very engaging
it's exciting thing. So two things was his backstory: failed 5 times. He started in a basement. He was investigated by the police for running a prostitution ring because his neighbors didn't know what the heck was going on. But he persevered and grew this company. The other thing that I thought was interesting that we didn't get to highlight enough, and I'd like to talk to him a little bit more about, is the fact that when he talked about sourcing of the electricity, he spoke about wind and solar exclusively. Mm-hmm. Right, which would bring it into true zero emission. Because if you're electric vehicles and they're sourcing it and you're just fueling more coal plants, is that zero emission?
I don't know. Is it? That's a great question. One that a lot of researchers out there are trying to figure out.
Maybe we'll have to get a philosopher on.
I know another researcher out there looking at the freight markets and looking at capacity and tender rejections, and that is Zach Strickland. What do you have for us today in SONAR, Zach?
So today we're watching, kind of this first significant jump in both volume and rejection rate. Now I say significant, which is relative to what we've been seeing, but the rejection rate, of course, the rate at which carriers are rejecting their tenders from the shippers, as it goes up, there's an implied increase of rate pressure, therefore decreasing capacity in a certain market. Now, 5.58% is not a huge number, but it is a pretty significant jump day over day. We're about 21 basis points, or it was 5.37 yesterday. That's one of the biggest jumps that we've seen in the rejection rate here in the last month or so. So it's, everybody's kind of sitting on these volumes. Carriers are taking on as much volume as they can, willing to, keep within the route guides. And so these first moments where we're starting to see this this significant increase of rejection, is it the start of a trend or not? And I would say, obviously, it's a little too early to tell that, but we did just have, a tropical system hit the coast, the Gulf Coast this week. And it does appear to have at least somewhat impacted some of these inland markets a little bit in terms of capacity. And this is where we're seeing the highest rate of rejection. So the Memphis market, Cape Girardeau, areas around Missouri, Arkansas, et cetera, did see a pretty significant jump in tender rejection rate. And Memphis, for instance, they jumped all the way up from under 5% to 9% here in the last week or so. The tail of that being the biggest increase here over the last day or so. So, tropical systems do get a lot of credit for disrupting the transportation markets, but that's mainly due to the fact that, during these disaster management situations, a lot of trucks choose to go and service that freight versus necessarily being disrupted and not being able to get into an area, which I don't think that's the case here, obviously, as there's not been a significant amount of damage or anything like that from this, but flooding along the Mississippi is a big deal, and it can prevent carriers from getting in and around certain areas like that.
Yeah, I was going to say, when you were talking about Memphis area and those type of things, and talking about these tropical systems and events that can affect capacity and people's ability and willingness to actually service those markets, when you're looking at the outbound tender market share and outbound tender volume share in SONAR and using the week-over-week change on a map, you can start to see a change from the edges of the company or country or the coasts in a little bit more inland.
Yeah, I think that's, and that's what we're seeing. Like, a lot of the freight has been pumping out of Los Angeles. I think LA has been one of the only areas that has seen any really, I want to say significant tightening of capacity, just because of the sheer volume, and of course the ability for carriers to manage the West Coast volumes is a little bit harder than, say, the East Coast because of the density out there. You don't have a lot of cities positioned close to each other like you do out east, so it's harder to have a lot of freight or a lot of trucks moving into that area. And a lot of that freight is long haul freight coming across the country, more than 450 miles moving between cities. So, to see this happen on the East Coast, or at least over this, middle part of the country is kind of news to what we're seeing so far. But volumes still remain elevated. And this is, somewhat surprising to me. I don't know about everybody else, but they do appear to have some sort of stickiness. A lot of the debate was over the fact that, okay, we're seeing this surge in volumes. Is it going to hold up? Are we going to see the recovery that we, expect to see? And it does appear to be holding up, at least for now. And we have fallen into some, at least, semblance of seasonality in the market so far.
Yeah, the trend is definitely very similar to the last 2 years, especially post-Memorial. Last year, before Memorial Day, we saw that unseasonable decline or trough right beforehand. But post, the small decline and then kind of steady, and now a little bit of an uptick, or actually a fairly decent uptick. It's recovering much stronger than it did actually the last 2 years. It's kind of interesting to see. So where is it now? I mean, if you're looking at the coastal cities, do we look to import SAC, or do we look to cross-border traffic? Where are those? Where are you looking to try and dissect and figure out what's happening in the near term, or is there a first leg of a W drop coming?
Yeah, a little concerning on that note is the fact that imports really not coming in with any significant volume right now. Looking at the coastal cities like Los Angeles, Long Beach, they had their early May resurgence in volumes. Savannah had one slightly here just recently, but that has since petered out. We're no longer seeing a lot of robust growth of imports, and the concerning part, to me at least, is the fact that a lot of these inventories that are moving out of these cities, Savannah, for instance, had a big surge of volume coming out of it just recently. Los Angeles, obviously, having a lot of that volume pushing out of that area. A lot of these are DC heavy areas. This has been what we've been talking about over the last few weeks. Eventually, they're going to run out of stuff to move if they're not getting replenishment from overseas or across the border in Mexico, et cetera. They're going to eventually run out of freight to move, and we're not seeing a lot of volume coming into the ports just now. And again, it's going to take 4 to 8 weeks. Once these shippers realize that they're running out of inventory, it's going to take 4 to 8 weeks for it to even show up in the port. So a concerning aspect of this to me is the fact, are we going to see some sort of buckling as the volumes peter out of the inventory, out of the warehouses on these coastal cities, and they have to sit and wait for some of these imports to come in and replenish these warehouses for freight to move? That's a big question moving forward.
I do have some good news on that. I was talking to Greg Miller, who leads our maritime team here at FreightWaves, journalist. And he was telling me this morning that those volumes are on their way, right? That there's an uptick in volumes coming from Asia into the West Coast, and he'll be writing some articles on that to this afternoon and tomorrow as well. So that's good news on that. Before you take off, Zach, can you give us some highlights in the refrigerated market and produce season?
Yeah, produce season continues to have its nice steady increase in terms of spot rate, activity, et cetera. We appear to be in a pretty stable holding pattern. It's just, again, much like last week, we appear to be in this very healthy, somewhat alarming for 2020 in the way that the produce season has not created a huge amount of disruption, but it's also not had any real significant lagging. So we're not seeing the weather patterns, wreck the yields. We're not seeing intermittent shipping patterns, et cetera. We're seeing just steady growth out of the spot rates, out of the volumes, which should continue here over the next couple of weeks. So our refrigerated sector is having a pretty healthy segment, and I think that depending on your perspective in this market, you don't really necessarily want to see those rates spike to the extent that we saw in 2017 or so, because that indicates a very unhealthy market condition, especially on yield volumes, et cetera. So just a nice stable growth pattern is kind of what you want in general, I believe.
Yes, definitely. Thank you very much, Zach. I think you guys are you guys talking about on Freightonomics tomorrow at 2 p.m.? Is it on the produce markets or the refrigerated markets, or is that a week from now?
No, that'll be probably next week.
How about, what are you guys talking about tomorrow at 2 p.m.?
I don't know just yet.
Okay, fair enough.
Fair enough.
Fair enough. So it'll be a surprise.
Right.
It'll be a surprise topic, 2 p.m. on Freightonomics. Thanks you again, Zach, our Director of Freight Market Intelligence here at FreightWaves. And our next guest in just a second will be Anthony Smith, our lead economist. On Friday, the unemployment numbers came out. Michael Vincent, and there's some confusion around it. They printed some really good numbers, but is there a misclassification error in there? It's something that is
we need some
still
clarity.
Kind of murky.
We need Anthony to clear this up for us for certain.
We really
that is
do
for
need,
sure.
To get some clarification on that.
Was it 19? Was it 17? Is it 13? Was it 24?
Yes, what exactly is the miscalculation error? What do you have on that, Anthony Smith?
That's right, Kevin. So we got the latest unemployment rate report last Friday, and we did see a bit of a surprise. So it came in at 13.3%. And this was indeed a bit lower, a lot lower than many people were expecting, many economists were expecting. As we mentioned in the last show, something around the high teens, maybe even in that low 20% mark. So there is quite a bit to unpack in this latest edition for the unemployment rate. One of the things that we did see was that there was a misclassification error on there. And so we saw that many from the survey were questioned, and when they were asked for job status, it was classified as, I believe, temporarily out of work, but it was misclassified as them being employed. So this classified them as really missing out on the whole impact from COVID. A lot of those who have been impacted by COVID were misclassified. So that really kind of brought that number down. Many expected it to be somewhere in the 16% range if this classification error had not occurred for this latest month of data.
So, Anthony, what's your take on this jobs report? Is that positive or is it negative, or is it neither?
Sure. So it's a little bit of both. So the positive is, if there is a positive, is that roughly 3/4 of the respondents, even though this most recent report had a limited or smaller amount of respondents, so that also probably curtailed the numbers a little bit. About 3/4 of those respondents signaled that they were temporarily laid off, and so that really talks to the amount of folks that are going to be in a position to kind of get back into that employment field once more. So looking at that many people, 3/4, that's a significant amount of people that are just saying, hey, this is just a temporary thing. I'm in contact with my employer. I'll be brought back as more of the country starts to open back up, or more of my region starts to open back up. So that's a positive outlook, if there is one, to be taken away from this report. But that doesn't mean that there won't be an overhang. There's definitely going to be an overhang when we're looking at the overall conditions for employment. So there are going to be many permanent losses throughout the country. And this is going to be for folks that were maybe in, say, a pilot, or something like that, that's not going to be able to really ramp back up fully as things really start to open back up. And so these are going to be an overhang. This isn't just a temporary layoff, but a permanent layoff, because even as we're in the full swing in the midst of a recovery, there's going to be a lot of individuals that are going to find themselves out of work, because even as their company comes back online, capacity just isn't there anymore. And even if things are in full demand, it's just going to be a completely different environment than when it was in February and March, early first half of March of this year.
Yeah, I would think that, the conversations that I'm having with different people, Anthony, and including yourself, there's concern out there that there's, the PPP right, is propping up some businesses and rightfully so, and helping people out through this time where they've been furloughed, out of work, et cetera. But now these companies are going to be opening up to what? 50% of the demand they had, 25% of the demand they had, 70% of the demand that they had for specific, depending on the industry that you're in, right? So there's that concern that they'll reopen but then fall. So these people will be reemployed but then boom, go right back into unemployment as these companies fail as they try and come back on, and the demand's not there, right? They're only at 75%. And then you have the extension or the change in the PPP, right? So if you have 50, you had 50 people that you were paying for that you were using the money to support, right? But now it's only going to be 25. You've got more time to make up that money and still have forgiveness on that loan. So you could actually lose those 25 people. Will that negatively affect the unemployment rate? You have the ability now, if you have more time, you have the ability to carry less people on your payroll during that time to get forgiveness for that loan. Those are just concerns, thoughts.
Well, so Anthony, job hires and quitting. I think you noticed that there's some data out on that. What do we have on job openings and quit rates?
Sure. So when we're looking at job openings, the most recent report did definitely show a drastic drop as expected for April going into May. But one of the things I like to look at was the quit rates, and what we saw was that that quit rate dropped to 1.4%. So this is expected when you're looking at voluntary separations. That is going to be something that's a little bit more rare as expected today. So folks are not feeling as confident as they once were, expectedly so, when looking for a new work or for looking for new employment. So people are really hunkering down if they are able to find themselves in a ideal position during this time, whether it might be able to work remotely or safely or in a socially distanced manner. They're opting to choose that stance and that employment. So when we're looking at that quit rate, it's still very, very low. It's going to be, I think, something that we're going to see start to rise on perhaps when we're in the midst, that upswing of a recovery, when we're really, really in the thick of it, kind of like that continuing claims number starting to come down. So this is going to be something I think we're going to see on the very latter half of any type of recovery. And that kind of quit rate is going to kind of talk into the consumer confidence, the consumer sentiment, not only in just their job outlooks and prospects, but it's going to have other psychological impacts as well. If you're not feeling that confident about your job prospects, you're not going to be making a lot of big ticket purchases, or really a lot of purchases that are kind of going to be kind of pushing your budget a little bit. You're going to be saving a little bit more. So watching that quit rate is going to be really paramount, I think, in the coming months, and maybe in the next 2 or 3 months here, just to kind of see where that sentiment is for consumers when we kind of look at the latter half of this recovery.
Excellent. Thank you so much, Anthony. We'll have him back on. Well, he's got what, Freightonomics?
Yeah, Freightonomics at 2 p.m. Subject to TBD, and we'll have you certainly. We'll see Anthony again on Thursday at noon for the initial jobless claims numbers.
Yeah, absolutely. Yeah. So next we have Kyle Lintner, principal and managing partner at Kate Ratio, coming on to talk about freight markets, what he's seeing in there, his kind of take on that. Is Kyle? I believe he said he was there. Do we have Kyle? There he is.
Hi, Kyle.
Hey, everyone.
How are you doing today?
Doing well, my friend. How about you?
I'm doing quite well. Thanks for coming on. Appreciate it. So,
always.
So you had some your weekly update, and you talked about some things on LinkedIn concerning the freight markets, and I can bring out some of those charts just to kind of set the scene here, because I'd like to get your thoughts on why they are where they are and where they're moving, and kind of expand a little bit on some of those thoughts that you put out there on that update. Does that sound good for you? Okay,
yeah, I'm all for it.
All right, so let me first pull up here. I've got The outbound tender volume index, and if we can show this on the screen, Cody, I'm not sure if we can get everybody to show this. I can talk to it if not, but okay, so here we are. We're looking at the outbound tender volume year over year, right? 2020 is right here in this green mountain. You can see its elevation. Now, I've got 2018 and 2019, and you can see what Zach was talking about and what you spoke about as well, Kyle. It is well above even the height of 2018. Volumes are definitely up. The other part of this, because there's a couple parts to this to kind of talk about, is outbound tender rejects. So here's the outbound tender rejects. We're just looking at the volume of truckload, all modes, flatbed, dry van, and reefer in the previous slide, or the previous dashboard. And now we have outbound tender rejects, which is also all modes. And these are the ability or the willingness of the carriers to pick up that freight. And you can see it's way down here at 5.58, which is above last year, which is nothing to write home about. And you see, Zach talking about a significant uptick. Well, here's a significant uptick of tens of basis points. The same time last year, it actually jumped from 22 to 24, 28. So, it's roughly, in 2018. So, that's where we were looking at extreme pressure on rates. So a little bit, it's still 1,900 basis points down, right? So not all that great. And then you look at the DAT, if we look at the DATVF.VNU, which is spot rates, right? And I look at this let's pull this out for full year. Here we are sitting right here. Let me pull these crosshairs out. So here we are sitting here. Now we have been slightly above, pulled forward over 2019, but nowhere near 2018. And we start to see this kind of level off, or possibly even a decline to fall under 2019. So there's the stage. Did I set the stage correctly enough, Kyle?
No, yeah, you did a great job.
Great. So what is it what are you seeing here? What do you make out of this information?
Sure. So to continue what we're trying to do with setting the stage, I'll just elaborate on what I was initially trying to say, and that's, we don't have the full picture. You guys do a great job over at FreightWaves with SONAR, and you're able to show us most of the components. The only piece that we're missing is capacity. So with any market, and I would say that freight is obviously a market now, especially because we have these components out there to view from a data standpoint. You have supply and demand, and where those two intersect is how we get price. So when going through what's on SONAR, we can see volume, which is demand, and we can see price. And by having two of those three, it's like being back in high school math. We can figure out what the missing component was, and that's available capacity or supply. So what I was trying to say was, hey, everybody, look, we need to do some comparables, and let's look year over year for volume. Obviously, like you just showed and like Zach was talking about, volume right now is extremely strong, the highest on record. And then we look at tender rejections, and it's almost the same as last year. And I think everybody would agree that 2019 was a very, very tough year for carriers. I'll put it like that. So if rejections are low, but the volume is through the roof, then I get people asking me the question, why aren't rates more like 2018? Why are rates, albeit better than 19, but still kind of depressed? So then we have to try and think through this. All right, if I have the equilibrium of volume and capacity meeting with muted results in price, this must mean that there isn't an even distribution of that volume. And that's what, like Zach was talking about. We see a lot of this concentrated on the West Coast, and particularly LA. So then I wanted to take it one step further and show rates for outbound LA, which are screaming. They're 60 to 70 cents higher than what they were just a few weeks ago. And that's somewhat alarming for those who, from a shipper standpoint, but for obviously brokers and carriers, it's what you like to see. So then one of the other things I threw out there was, if you take just tender rejections from LA against all the other major markets, you can see that LA is clearly moving away from the pack in that sense. And that's extremely important, because if we want to look at cancellations for a market like LA, which is so much larger than any other markets, just a 1 percentage point increase in tender rejections from the nation's largest freight market means significantly more than some mid-tier market having a 5 or even 10% move in rejections. Taking that one step further, I showed the rates for that entire West Coast region against the South and then against the East, and you can see that West Coast rates are clearly outpacing everything else. So what we can infer from all of that is that there is volume that is moving out of LA, and it needs to get somewhere fast. Like Zach said, a lot of this is long haul, and I mentioned that a couple of weeks ago. That's a very positive sign for everything too. All of that means is that the shippers don't care what the price is going out the door. They need those goods moved fast, and that's a positive sign for the economy, because that means that the U.S. consumer, who's 70% of GDP, is starting to come back.
Are we also seeing, you said that there's pockets where activity like the West Coast, right, or outstripping the other parts of the country. Do you see that in mode as well, like dry van, reefer, flatbed, that it's really concentrated in dry van and probably in an industry of essential goods, or are we spreading this over other industries or non-essential, maybe discretionary spending? What are your feelings on that, Kyle?
That's a really good question, and I think the answer is discretionary. It's going dry. So we obviously have strength in reefer. The produce season is still going on, although it is winding down. If you have the dry going and it's coming from LA, we have to assume that this is consumer demand for retail goods. But Zach hit the nail right on the head. We did see the drop in imports into LA. So this is from warehouses that are already in the area. And that's why I mentioned markets like Phoenix and Stockton. They're going to see this next, because if LA is demanding such a high premium in rates, any available capacity in the general area is going to head to LA. I had a conversation with a carrier in the Midwest who said that he has all of his trucks west of the Mississippi just head to LA because it's easier for him to get back to Missouri and Ohio from LA than it is from him to take something from Texas. And he knows he's going to get paid rich for it anyway. So I don't know how long this situation lasts, but like I mentioned in the video, price is just an advertising mechanism. And right now it's telling everybody, hey, there are goods to be moved. I don't care what the price is. I just need the trucks to do it. So that's going to soak up any capacity in the area. And that's how we get that domino effect from first problem will be LA. The surrounding markets will become the next problem. And then if this holds up, then we get the nationwide move up in rates. And that's how we get a sustained move higher, from this, call it bearish 2020 start.
Yeah. So there's the question. You're looking at the long haul coming out of there and the volume. So the question is, how long can this sustain?
Right.
And I look to those markets as, and if we bring up the chart one again, please, Cody, if we could. I've got the maps up here of the United States, and we're look. Okay. That's my F11. If I could just listen to myself and pull up the chart, we'd be in great shape. So I've got it up here, Kyle, and what I've got up here, and for everybody, I've got a heat map on the left-hand side of the United States, market outbound tender volumes. This is the latest reading. So this is today, and the outbound tender rejects is the height. And we're looking at this. You see the dark areas down here in the Inland Empire in L.A., and you see it over here in the port cities, et cetera. And the outbound tender rejects are starting to actually become higher in the inland as those trucks start to move that way, right? Even though O-Tribe right now, or the rejections and the rates are being pushed up. If we look to the right-hand side here, we're looking at the weekly change in outbound tender market share and the outbound tender volume on a weekly change. And you can see these seem dark blues over week. They're starting to weaken, and the inland is starting to heat up a little bit. So there's this fragmentation that's going on. And then when we take it out to maritime and look at some of these maritime indicators.
You know what? Hold it right there for 1 second, Mike.
Okay.
And I don't want to interrupt you, but this shows a very important point that Kevin was alluding to about mode. If we go back to that chart and we look at the outbound tender market share, you can see that the change, the weekly. You can see that Inland Empire and LA and that general area is increasing. And then we look to something, and I hate to do this because I keep picking on it, but look at Chicago in the deep red for the market share drop. So what's one of the most voluminous, busiest rail lines out there? It's LA to Chicago, right?
Yeah.
So if we can see Chicago continually staying in the cellar, never increasing in volume, what does that tell us? Those goods from LA aren't going via rail to Chicago for further distribution. It's going over the road long haul because whoever needs it on the other end needs it now and doesn't have the time to wait for the cheaper rail route.
That's a solid point. And the other thing, just real quick, because we're running out of time here, is Now we've got imports that have been down, and I was going to show some things that were down, and we can take this off screen here. But we're looking at other. So the imports have been down. Greg Miller's starting to say they're coming up. We've had a few of the alliances unblank a couple sailings, but nothing really significant. So it is coming, but it has been down for a couple weeks, and the across the board, all industries, imports, just maritime imports, just down. So we're starting to see these volumes evaporate a little bit. Are we going to go into it? That, to me, would indicate we're going to see a little bit of a dip that's going to happen from these type of ports. It's going to move inland type of thing, and then we'll see it come back. But it doesn't bode well necessarily for rail, does it? Because these now, if we have a 2-week lag or 3-week lag of those inventories or that freight to hit the docks, it's going to have to hit the trucks pretty quick. No, Kyle?
Well, I'll tell you, I think we're okay. And really quick, we have time, we can show why. If you pull up a chart of total business inventory to sales ratio, you'll see that right now we have a number that hasn't been seen since the depths of the great financial crisis in 2009. So we have a ton of goods on hand, and that'll hold us over until this new merchandise comes over from China or whatever points west. Usually you don't want to go hand to mouth. I don't think we're going to get into that situation just because we have so much merchandise in the warehouses and in the distribution centers. So it's a patch, but I think it's a large enough patch to hold us over. Otherwise, yes, this little boom that we're seeing right now could quickly turn into a bust. But I think we're safely into a cushion that we'll be all right. Pull up an all year, you'll see that.
Yeah, I just pulled it up. If we could put that on the screen real quick, I did F11 already. So, so there. This is what you're talking about, and looking at this right here, boom. This spike right here is showing you that we're draining since March the warehousing. We've been draining. Solid point. Hey, Kyle, thank you so much for being on. How do people get in touch with you and K-Ratio?
Thank you, always. Easiest way to do it, I'd say, is k-ratio.com.
Excellent. Thank you so much, my friend. Stay safe out there.
Thanks, guys. Good seeing you.
Always a good analysis, my friend.
It's always a good analysis. He always brings great insights into the markets. And certainly if you don't follow Kyle Lintner on LinkedIn, please do. He posts a lot of really great content out there. One of our favorite contributors to LinkedIn. And
yeah, absolutely.
FreightWaves
absolutely.
As well.
Yep. Very insightful. Who do we have next here? We've got Alan Adler. Is he on?
No, he is not. He's not ready yet.
Oh, he's not ready. Okay.
Yeah,
all right.
So we have a couple minutes before Alan comes on.
We do.
And we have some fewer comments here.
Okay.
I'm running behind on those. Eric Serta, Vice President of Marketing and Business Development, I believe at Valor, says air freight and falling shouldn't be put in the same sentence.
Yeah, I saw that comment. I agree.
Yeah, true. Yeah. So, air freight and falling shouldn't be put in the same sentence. You have a very good point on that. Chitranja Sandhu, trucking proudly, says rates are dropping fast in California this week. I wonder if that's Southern California, Northern California, produce.
I don't know, but I would think that looking at the maps we just went through and talking with Kyle Lintner, he's expecting them to start coming back down here in the next week or so.
So,
anyway.
the recovery that you're talking about, right, where it starts out here and then comes back and recovers, is called the square root recovery. And it's something economists...
Or is it the reverse square root, right? Because then it's kind of opposite of what you would...
Well,
but then it
symbol.
comes up. But I think it's going to be up, go down, and then stay lower once it comes back in normal.
Yeah.
So that's kind of the backwards square root, right?
It's somewhat of a square root, right? It's
we'll
not
let
exact.
someone comment if they agree if it's a square root or backwards square root. But I think we have Alan now.
I think we do have Alan now. Hi, how are you doing today, Alan?
Hey, good, Kevin. How are you?
Oh, we're doing
Hi,
great. We're
Hello,
doing
Alan.
Great.
Alan Adler, our Detroit bureau, right?
Detroit bureau chief, talking a little bit about Nikola. And you have an article out on FreightWaves.com now that you published this morning about their IPO and talking with one of the investment bankers who did the SPAC. So let's explain a little bit about what a SPAC is to everyone out there who is unfamiliar with that term to start off with.
Sure. Let's do the definition. A SPAC is a special purpose acquisition company. Basically, it's a shell. It's a shell company that's created so that it can go out and buy another company. And that's what this group called Vector IQ was. It was created a couple of years ago, funded it did its own IPO for about $230 million. That's what Cowen helped with. And then the whole point was to take a couple of years, look around for a company that it wanted to invest in, and then go after that company and arrange a merger. And that's what happened.
Yeah, and it's another name for it is a reverse merger or reverse acquisition. Is that right?
A reverse merger, blank check company. There's a number of terms. What's unique about this one is that in addition to that $230 million that was raised for Vector IQ, there was another $525 million raised in another acronym called a PIPE, which is a private investment in public equity. So there's another acronym for you that basically provided more money so that when this merger closed last Thursday, when the trading began, Nikola got $700 million in cash right away for its business.
What's one of the, so Nikola went the alternative IPO route to go public. What are some of the advantages of that? And are we likely to see more tech companies in the transportation logistics space go after that type of going public through alternative means in the coming months and maybe 2021?
I think we are going to see a little more of that. A couple things have to happen. You've got to have a really big market opportunity, and a couple of those are obviously autonomous vehicles and electrification, like grid development, things like that. Those two areas, according to the banker at Cowen, are really good candidates to see these reverse mergers. And one of the highlights, I did not realize this until I talked to him, that the SPAC allows is you can do your projections for what you're going to create in revenue versus having to show what you're already doing. What that did for Nikola was it probably speeded up their public offering or their ability to go public a couple of years. They probably would have gone public eventually through the traditional IPO route, but the SPAC speeded that up for them.
You kind of eliminate the roadshows and I think it's S1 filings that you have to do that we saw Uber do and Lyft and a couple other kind of automated or transportation companies do in the last 12 to 18 months.
So what's happening with Nikola now is people are finding out what's going on. I was just looking at a quick interview that their CEO did on Yahoo this morning, and he said they had 300,000 new investors yesterday, which, their stock run up is something that's part of the story. They're trading in the 80s right now. When it was Vector IQ, it was $10. So you can see what's happened. The other thing that's happened is that Trevor Milton, the CEO, has become very, very wealthy, pushing decabillionaire status now. Doesn't like to talk much about that, but the fact is he's doing really, really well personally because he owns 35% of the shares in the company, about 91 million shares.
That's a healthy bank account. Or stock account.
Go Trevor.
It's on paper. It's on paper, right?
Definitely. Really quickly, we're running out of time, Alan, but you also wrote earlier this week, I think it was yesterday, about truck stop dining and that coming back online and some of the changes that we'll see in the future. What will we see?
Well, obviously, the social distancing that is so much a part of reopening all businesses. So less seating, 25 to 50% occupancy in some of these dine-in restaurants. But to me, Kevin, the thing that was so interesting is that a lot of truckers have found other ways. They're getting by without this now. And one told me about her Instapot, that she's basically pressure cooking a lot of her and her husband's meals. They're a team driving group and team driving. And so she said, we're probably eating healthier. She said, I don't really care much for a mask anyway. She said, and it's just a lot of extra stress to even go in. Obviously, TA and Love's and others are hoping to get these restaurants opened as states allow, but it's going to be very, very different.
It will, and it shows you that necessity is the mother of all invention. If people have to find another way, they will find another way.
That's
and
exactly right.
Oftentimes it's better. Thank you very much for your time today, Alan.
Thank you, Alan.
How does anyone reach out and contact you?
You can get me, and please send me any ideas you have for stories, especially around heavy-duty trucking and equipment. Adler at FreightWaves.com. You can also find me at Alan Adler, AlanAdler, on Twitter, and that's a couple ways.
Very good. Thank you very much for your time today, Alan. Interesting news on Nikola, and
very good,
and SPACs and other ways to go public besides the traditional IPO route.
Yeah, that's very interesting.
Yes.
I didn't know about the SPAC or what that actually meant.
It's a little confusing, but once you start looking at it,
it makes sense.
It becomes the complexity kind of dies away.
Yeah.
Good news. What do we have for?
We have time for good news.
We
I know
do
we're
have
running
good.
Yeah. Okay. So what's good? So. Peter Rensselaer, CEO at Carrier Direct, posts on LinkedIn. Andrew Silver of Molo Solutions, his recent What the Truck interview about the Black Lives Matter movement is one of the truest forms of leadership I've ever seen. This is the exact reason we've been saying logistic leaders need to be afraid of the next generation of leadership, and a prime example of leading from the heart. He is concise, action-oriented, and responsive to a critical social issue. There is no more separating personal and professional. They're intertwined, and people want to work for leaders that care about more than just the bottom line. Molo is a smaller company, in parentheses, company that's setting an example we can all learn from. If you and your leadership aren't thinking about business differently, you will die as a business and lose to great leaders like Andrew and the team at Molo. At this rate, they won't be smaller for much longer. Thank you, Andrew, etc. So, I mean, people are speaking out, right? And as protests around the country have shined a spotlight on racism across the industry, we've been trying to add to the conversation by putting leaders up on our platform and talking about it, but also looking at everyday workers pulling freight and the drivers, right? So Clarissa Hawes published an important article where drivers share their experience with racial bias and talk about ways we can improve. Recommended reading. Calling out racism in trucking. Clarissa Hawes on FreightWaves.com. Check that out.
Yes, it was our feature story this morning on FreightWaves.com, so you can catch it there. We also did a survey on transportation and logistics professionals, every from drivers to CEOs, to see kind of how prevalent racism is, or their thoughts on how prevalent racism is in the industry. So it's very interesting results on that you can find.
Is that on FreightWaves.com as well?
It is. It's inside her article on FreightWaves.com, and that's Clarissa Hawes.
Excellent.
Yeah.
So you've got Put That Coffee Down tomorrow?
Yeah, but I have 2 p.m. Andrew and I have Great Quarter Guys that we're going to do at 2 p.m. Eastern Time. So here in about an hour after we wrap up right now, it's going to be on auto manufacturing, kind of indicators for the economy, and also Hertz, kind of that bankruptcy, how that feeds into, and how ultimately it gets to freight demand. So we'll be talking about that at 2 p.m. Tomorrow at noon Eastern Time. Dooner and I will be
that's Put That Coffee Down.
Put That Coffee
tomorrow.
Down.
Right,
the Freight Sales Podcast. We'll be talking to Brent Orsuga from Pinnacle Recruiting, talking about the second half of the year, kind of a little bit of a sports analogy. Again, building.
It was one of the most difficult things in it because it says how to come out of the locker room strong.
How to come around. I mean, we are about 2 or 3 minutes or 2 or 3 weeks away from the second half of the year. So it's this, if you're not hitting your numbers, what do you do now to prepare yourself for a great second half of the year? So it's a very important discussion that we'll be having. And then at 2 p.m., Freightonomics, a TBD.
It's going to be so awesome they just couldn't talk about it.
It's always awesome. Zach and Anthony.
That's right.
And then 4 p.m. with SONAR with Luke and Kyle. And
tomorrow we're back here with Midday Market Update, and then Thursday we are, and then Thursday at 4 p.m. I'll have Jason Miller, Associate Professor Logistics at the Eli Broad School of Business. We'll continue our discussion off of LinkedIn and some other views on the market recovery and what's going on. Some different perspectives. He relies a lot, very, very heavily on macroeconomics, et cetera. So it's interesting to get the viewpoint from a more traditional academia of what's moving forward. So that'll be a good one. It is.
Yeah. He's always got good research, good insights, especially in the macroeconomic trends.
That's right.
Really good.
And Friday at noon, we'll blow your doors off again with another epic What the Truck.
Yeah. Do we have anyone lined up
I don't
yet?
give that away. I'm not giving it away right now.
You're not giving it away?
Stay tuned.
So it's all going to be under wraps.
Stay tuned.
You know, you had a great episode last Friday that you can find on Freightcast. You can find all these shows on Freightcast, TV.FreightWaves.com. You can download FreightWaves TV on any number of different applications, Apple TV. I have mine on my Fire Stick, Roku in the office here, so you can download that and watch at your convenience on your TV.
Absolutely.
Which I watch you guys on What the Truck.
And where do you go? TV.FreightWaves.com.
You do, yes.
Sign up now, register, get the latest insights, know what's going on.
But that wraps it up for this edition of the Midday Market Update.
Peace and love.